Hey everyone, it's Dave Keller here at StockCharts.com coming to you from a hot Redmond, Washington. How are you? Good to be with you live here on the YouTube here on Wednesday, August 16th. Hope you guys are all doing well, navigating these markets okay. It's certainly a challenging environment and what I would call a rotational environment, right? This is one of those times when I think we're starting to see some clear change of character from a bullish phase, which is the story really through July of this year, really into more of a pullback phase or a corrective phase. You see a lot of stocks failing to break out. You see gaps lower that are sort of following through. So a bit of an inflection point of sorts. So on my show, The Final Bar on StockCharts, we've been talking a lot and tracking that rotation. Today, what we're doing on YouTube is just doing a live Q&A. We're planning to do this as a weekly exercise. Should be a lot of fun. And here's what I'll do to set the table for you for this delicious meal we'll have together here for the next 29 minutes or so. The Q&A is open. The chat is open. Drop your questions in there now. I have a couple just sort of warm-up charts to get us started, just things that I'm observing this morning as I'm doing my morning coffee routine, looking at a series of charts that I look at every day. And then I'll start digging through the chat. So put your questions in now. We'll get to as many as we can in our Q&A. And I'm starting now with the chart of the S&P 500. What's interesting if you look at the S&P is that, as I mentioned, not too long ago, right? Less than a month ago, we're talking about new highs for the year. We're talking about the S&P making a new high every month in 2023 until August. And so far, and I would say it looks highly unlikely that we're going to continue and make another new high for the year in August. It's possible. The market can always turn on a dime. But when I see the S&P and the NASDAQ breaking down through their 50-day moving averages, it makes me feel a little more cautious than optimistic. And the way I tend to think of charts like this is, have a line in the sand, have a level, a clearly defined level or signal. And as long as we remain above that level, things aren't getting that bad, right? And so for me, the 50-day moving average, a trend line using the lows from March and May, that's kind of been my point of no return, I guess, point of minimal return, right? It's the line in the sand, and as long as we stay above that, things are good. Problem is, yesterday we closed below the 50-day moving average for the first time since March. Today, we're actually getting further distribution. Had a little bounce earlier in the morning, but we're kind of continuing to rotate lower. So it appears like today could be a follow-through day to the downside, and I think that is a foreshadowing of sorts of what August and probably into September is most likely going to look like. Now, the chart of the QQQ, of course, a similar breakdown to the 50-day. What's interesting is if you look at the S&P and the Qs and a lot of other names, like, growth leadership names like Apple and Microsoft and any of the FANG names, there's a lot of daylight below current levels. And that's the reality of a market that's been in such an uptrend, right? When you keep rallying and you get further and further away from moving average support, you can come down quite a bit and actually still have a pretty constructive chart. By my read, the S&P, the NASDAQ can actually get down to that first Fibonacci level. On the QQQ, that's around 340. I think a pullback down to that level and then a rotation higher in the fourth quarter would be kind of a classic pullback. That would be sort of an average pullback in a bullish year, going back for decades. That would, obviously be a decent drawdown beyond the drawdown we've had so far in the last couple of weeks. But again, still be above that first Fibonacci retracement level. And I think that's an important thing to remember. When things go up so aggressively, they can certainly come down, but there's just a lot of space until you get to the really painful support level. So I would argue that there's probably room below current levels to still be sort of long-term bullish, but short-term on the tactical time frame be pretty frustrating. As a reminder, put questions in the chat as they come up. I'm happy to go anywhere in terms of technical indicators, technical analysis, the StockCharts platform, market history, behavioral finance, classical music. I'm open to it. So wherever you want to go, I'm fine with it. Last two charts I'll show you, and then we'll get to the questions. The S&P, of course, breaking down the 50-day, but another thing I like to do is look at the breadth conditions. And I measure breadth a lot of different ways. Again, on the Final Bar, our closing bell show, we hit on breadth pretty regularly. And what I'm noticing today is all four of the advanced decline lines for the New York Stock Exchange, for the S&P large cap, S&P mid cap, and S&P small cap indexes, all four of those are basically right at the 50-day moving average today. And I would say those advanced decline lines fail to hold the 50-day, just further validates what I think is sort of that rotational feel that we're seeing. Breadth conditions got really overheated in July because the growth stocks had been doing well. All of a sudden, value sectors like financials and energy, maybe some materials, Industrials certainly started to show renewed signs of strength. That caused all the breadth indicators to get pretty bullish pretty quickly, but all of a sudden get to extreme bullish levels. And that's maybe the last chart I'll show you here. So if you look at the percent of stocks above their moving averages, this is looking at the S&P 500. In mid-late July, you had about 75% of the S&P members above their 200-day moving average. That's now down to around 58%. Even more telling, though, you had about 90% of the S&P a couple weeks ago above their 50-day moving average, 9 out of 10 S&P stocks. Now that just dipped below 50% yesterday and continued to go a little bit lower today, around 46%, which means 90% of the S&P were above their 50-day moving average a couple weeks ago. Now it's down to around 45%. So literally 45% of the S&P has now broken its 50-day moving average on those individual charts. So this is a market in a pullback phase. I think, if you've not started to think about downside objectives and how you manage further risks to the downside, I would certainly be spending some time the remainder of this week doing so and trying to do some thinking about, how low you'd be comfortable with things going and what sort of ways you can manage that risk or mitigate that risk using options, using, some sort of hedging strategy, just taking profits and making sure that you're holding names that are still working and unwinding charts that are not working. In general, that's sort of the way I think that this game can be successfully played over the long term. With that as an intro and some charts, let's get to the chat. And thanks, guys, for putting this in there. Sakshi, you asked a couple great questions right at the beginning, and I'll get through these pretty quickly. Bullish percent for India, not available for the Nifty Sensex, 100% right. I actually talked with our data team about this last week. We have Milan Vaishnav, who's a contributor at StockCharts based in India, and I've talked with him randomly. I visited Mumbai last November, which was an absolutely wonderful experience. Got to sit down with Milan and meet him in person for the first time, even though we'd collaborated for a couple years. So it was really good to talk to him. We did identify some of the areas of the Indian markets where we could upgrade our coverage of that space. Just talked with our data team last week because we've had some requests to get more breadth data, all in the works. So we're kind of working on our global data coverage. India is one of the markets that we're hoping to build out initially. The U.S. and Canada we have pretty well covered. The U.K. and India sort of in the next bucket. And then we'll be looking to add additional markets. Australia is one we've certainly talked about and many others. So if there are particular non-U.S. markets that you'd love to see added to the StockCharts platform, let me know and shoot a message to our support desk. That's the best way to get that there. But in the works, and not just bullish percent indexes, we'll be looking at other breadth indicators as well. Next question, what's the difference between the PPO, the three different settings that you explained, and how can you use the PPO histogram for measuring the trend? Yeah. So here's my chart. So what you're referring to is what I call my market trend model. So I have this market trend model using weekly data. And the combinations you asked about are basically the combinations at the bottom of my page. So what I'm looking at is I'm trying for years would look at the weekly chart of the S&P every Friday, and I'd sort of take a look and just make a quick assessment. What's the trend on the long term, the medium term, and the short term? And for me, short term is a couple days to a couple weeks. Medium term is a couple months. Long term is 1 to 2 years plus, right? So those are sort of the general timeframes I'm trying to understand and appreciate as an investor. So what I did was basically come up with this market trend model, which basically systematizes or automates that analytical or that subjective process I was doing every week. So every Friday, I look at where the price is relative to the 5-week EMA, and I call that my short-term model. So that's literally just the difference between the 1 day or the current level versus the 5-week EMA, which is the line in kind of hard to see. It's kind of this light bluish color on the top. Then I look at the difference between the 5 and 13-week EMAs, and that's called the medium-term model. So you see the 5 is in sort of the bluish color. In green is the 13-week EMA. And then the long-term model is looking at the difference between the 21 and 34-week exponential moving averages. Those are the red and purple lines on the chart. So I have the 4 weekly exponential moving averages, and I'm looking at the spread between different combinations as just a quick assessment. And what I found after using this for a while was it pretty much matched what I was doing on my own, and so I found it was just a much better way of tracking trends. And I run this market trend model not just on the S&P, but other U.S. indexes, global indexes, other asset classes, and so forth. And it's a really good way of just kind of making sense of where things are at on the timeframes that are important to me. So The reason why these histograms are all different is because by looking at longer exponential moving averages, you're basically smoothing out longer periods of time, and as a result, the histograms are reflecting a bigger time period. And so, again, short term, medium term, long term kind of matches how I think of those periods. If you're more of a swing trader, if you're more short term oriented, I would probably have a market trend model with daily data and using shorter time frames. And I would encourage you to experiment with an indicator called PPO. And that's the way you do it, is basically use different combinations of exponential moving averages. And by doing them as a histogram, which the trick is you just put a little 0, 0 at the end of the parameters for each of those indicators, it turns it into a little histogram, which I think is a great visual way of showing those changes. That was an Arthur Hill trick. He taught me that in my early days trying to use the StockCharts platform more and more. All right, Ray, Hala from Barcelona. Bon dia, my friend. But it's actually evening over there. So sorry, I don't know how to say good evening. I'll look that. I'll have that ready for next time. I do know good morning because we did stay in Barcelona a couple years ago, and I enjoyed saying bon dia and struggling through that language as much as I could. Next question, Ken. Is there a way on StockCharts to find ETFs associated with the top performing industry groups? Yeah, really good question. So, couple different ways that you could do this. I'm trying to think of a couple different ways. So first thing I would say is that what you have to remember is on StockCharts, if you go to Charts and Tools, we have this feature called the Scooter Reports. And I love to refer to this. Actually, I refer back to this often. What this does is it uses our proprietary model at StockCharts called the StockCharts Technical Ranking, or Scooter ranking model. And we, if you click on the little magnifying glass and search for SCTR, we'll share the formulas. It's not a secret. It's not a black box. We actually show you and open up the lid so you can see what we're doing. But it's just a way of characterizing different charts and different stocks and ETFs based on their trend characteristics. The higher the number, it's a percentile ranking, so it goes from 0 to 100 essentially. The higher the ranking, the stronger it is relative to the other things in that universe. And when you bring this up for the first time, it defaults to large cap stocks, but you can bring up different listings or different universes. What I would point you to are two things, right? One way you could do it is look for industries, look for strong industries, and then do a separate sort of tool to try to come up with ETFs that track those industries. That's one way to do it. The other option is just use the ETF rankings. Now, the challenge with this, of course, is it's all ETFs. So it's going to be, things like Vietnam, which scores very well. It's going to be some other ETFs like UGA, which tracks gasoline prices. But as you go on, you'll see something like building and construction. This is an active fund managed by Invesco, looking at sort of home builder and home builder type names. So I would say, looking at this is probably how I would do that, is run the ETF Scooter Reports, and then you can start to look through and just look for the ones that are sector and or industry related. So like home builders, I'm seeing those sorts of things pop up, and that's what I would probably do to focus in on things that are getting it done. This is looking at the raw rankings, and you're sorting it based on that column. The other thing you can do, this is kind of a behind-the-scenes trick or a lesser-known trick, click period 1 week, and then sort on this column called change. And this will show you the ETFs that are actually gaining the most in their Scooter ranking in the last week, or losing the most in their Scooter ranking the last week. That could be a good way of identifying shifts. So as things just start to rotate, you'll find their Scooter ranking spikes very quickly because they've been really, really bad and all of a sudden starting to really improve. So that's probably how I would try to answer that question. Good question, though, by the way. Next one, let's see, Acorn. Trend reversal trade. You're looking at Rivian. Let me bring up the chart here and we'll take a look. All right, on Rivian, there was a bullish divergence both with daily and weekly charts as well in May, June 2023. Now, recently, stock made a golden cross, the 50 and 200-day crossover. So I think the question is this a trend reversal trade? So first off, I will tell you, I've done this for a couple of years, and the golden cross and the death cross, when the 50-day crosses up through the 200-day, fun names, and the media outlets that I've worked with love to ask about that because when something has a golden cross, it seems like it should be really important. When I've done any sort of tests on moving average crossovers, the golden and death crosses using the 50 and 200-day moving average, not the best setup. And I will tell you why, because they lag behind prices just enough that usually they give a buy signal right after something starts to roll over, right at the peak of it. And then once something bottoms out and rolls over, that's when the death cross tends to come. over really long periods of time. Like if you look at like 2000 to 2010, it did very well because the S&P was in these big, long, trends. But that's just not been the nature of the markets. Markets have been a little more volatile, a little choppier with, different sort of characteristics in terms of the drawdowns. And I think it's made that particular approach not as meaningful as it may have been. So I don't put a lot of weight into something having a golden cross. I tend to look at other places to find that sort of validation of a turn. You're picking up on a divergence, though, and I would say this is you were saying a bullish divergence here in May, June. I don't know if I'm necessarily seeing that using RSI. Let me bring up an indicator like MACD, which could be a little different. Here we go. So now we're looking at price. Yeah, see, I don't know if I would agree with that, only because a bullish divergence back here would be lower prices, higher momentum. Maybe this is what you're talking about, right? March, April, May. I would argue that that's probably pretty decent. At the top, though, I would say this is very much a bearish momentum divergence, and Rivian is not the only chart where you've seen that. You saw that on a lot of them. Notably, some of those growth leadership names like Apple and others had a clear bearish momentum divergence. Higher highs, May, June, July, somewhere in there. Lower peaks in momentum, so RSI, MACD, all kind of sloping down. That is a big red flag when you've had a stock or an ETF in a rally phase. The momentum improves, which is what you want. But then all of a sudden, the price keeps going higher, but the momentum starts to dissipate. That usually tells you you're in like the 8th or 9th inning of the bull phase as opposed to the 2nd or 3rd inning. I think the rotation lower we're seeing on charts like Rivian are finally sort of confirming what you probably noticed in June into July, which was higher prices on weaker momentum. So in my opinion, this is the type of chart that I would probably be staying away from. But I think in the short term, what I would be thinking about is the fact that we are now testing moving average support. And more often than not, when the price approaches the 200-day from below, you tend to find a little bit of resistance. Wouldn't be surprised if you get a bit of a bounce here. But overall, I think the divergences and the fact that things are rotating lower and breaking support pretty much more meaningful. Rivian, by the way, testing its 50-day along with the S&P and the NASDAQ and other charts that I mentioned earlier in this Q&A. Thanks for that question, by the way. Next one, congratulations on your crew, Nate. You're welcome. I mean, thank you. I appreciate it. This has been fun, and we'll hope to do more of these. But I appreciate all the thoughtful questions. Let's see. You were asking particular about AMD and NET, some technology names. Cloudflare, I think, is NET. Let's get to those. So, yeah, I think AMD, I have a real issue with the semiconductor space. And the issue I have is they looked really good a couple months ago. They look a lot less really good at the moment. And, that is the non-technical version of what I'm about to say. How do you actually quantify a stock or an ETF that is rotated from a clear bullish phase to a not as bullish phase? So I always start with Dow theory, which is Charles Dow Technical Analysis 101, literally the foundation of many of the technical tools that we use. You can trace back to Charles Dow, sort of late 19th century, early 20th century, when he talked about trends. And he said an uptrend is a pattern of higher highs and higher lows. A downtrend is a pattern of lower highs and lower lows. So, when the market's strong in the new year, which it was certainly at the beginning of 2023, you see this pattern of higher highs and higher lows. And I think AMD was a number of growth stocks had a similar pattern of higher highs and higher lows. And as long as that persists, things aren't too bad. And I would argue still today, there are plenty of charts that continue to kind of look like that, not to completely derail, like builders, right? Some of the building materials names in industrials, home builders come to mind. Keep making higher highs and higher lows. And as long as that keeps happening, I think the trend is positive. Where you want to be wary of is when that stops happening, right? When do we try to make a new high and fail to do so? And I would say that's what's happened with the SMH. That's what's happened with AMD and some of the other individual semiconductor names, is you've made a clear lower high. So for AMD, kind of peaking out around 120, 125. And now we've been really consolidating for the last 6 to 8 weeks. It's been more range bound, right? You have clear resistance level around 120, a clear support level around, we'll call it 107, 108. Now this week, it certainly feels like we're testing that support, if not breaking down. I think we're really close to the point where you have to admit we've now made lower highs and lower lows. And that's the type of chart I would be leaning away from. Again, as a reminder, right? I mean, what I was taught is if you want to outperform the benchmark, you need to own things that are outperforming the benchmark. And if you want to underperform, which hopefully you don't want to ever do, just own things where the relative strength line is going down. It's been kind of sideways because the markets themselves have been retracing, but I think semiconductors, which have been a bellwether group, are now starting to feel some downside pain. I'd be concerned there. With Cloudflare, it's a little different. It's less of a breakdown and more of a fact that it really has never broken out, right? And I think the way that I describe charts, I had Dave Landry on my show on the Final Bar yesterday, and he is famous. The first time I met him, he was giving a presentation. He handed out cocktail napkins, and it had 3 arrows. It was like bullish, bearish, neutral, up, down, and sideways. And his point was, if you can't illustrate your trading strategy on a cocktail napkin, it's too complicated. And I love that sort of simplistic but valuable, it's a robust approach. It actually holds up pretty well. So I tend to think of any chart as going up, going down, or going sideways, or how I would describe it, maybe an accumulation phase, meaning we're in an uptrend, a distribution phase, we're going down, or a consolidation phase, we're going sideways. I would argue Cloudflare has not been going up. It's been more consolidating. And the way that you exit out of that consolidation phase is to break out of the base, meaning you have this clear resistance level, and then that level is broken. And think about what that means. That means that, the market has become, has not been able to go above 70 really with any consistency, for over a year now. So until that can happen, there aren't enough buyers or enough buying power coming into the market that would propel net even further. So until this sort of chart gets above 70, 75, I would say it's at best consolidating. And at worst, there's downside that could be had to continue to fill in this basing pattern. So I'm seeing Cloudflare as sort of this big consolidation phase, which again has been going on, I think, for over a year, really since June of 2022. That's my quick take on AMD and NET. Thanks for asking about 2 technology names. Dave, how would you interpret a stock that gaps up, then bases above the gap, like Humana, and versus a stock that gaps down and bases below the gap but makes no new lows, like RTX, Raytheon? Which is bullish and which is bearish? Sally, thank you so much for those questions. Let's get to each one of these. Let's see, HUM. Right. How would I interpret this where it gaps higher and then bases above the gap versus RTX? Let me look at the 2 of these. I think this is incredibly telling. These are 2 really good examples, and these are not unique, by the way. I would tell you right now, you're finding a lot of things that are gapping, and then what happens right after the gap is really meaningful. We had a lot of these recently. I was just writing a note for my market misbehavior subscribers earlier this morning, and we were focusing on some of these gap stocks where we gapped and then just continued in that direction. So this sort of chart is pretty constructive, in my opinion, where you gap higher because think of behaviorally what happened there. From one close to the next open, something's changed. Might have been earnings or something. I'm not exactly sure what that gap was at the beginning of August, but something caused a big change in valuation from day 1 to day 2. Then look at what happened. Additional buyers were willing to step in, and even though the price had gapped up 20 points, they're thinking this is still a really good deal. And that upside pressure, that upside momentum, as shown by the fact that the price has gone higher, is a good sign. Compare that to something like Raytheon, which has gapped lower and now sort of continuing lower. So, investors are seeing this stock go from 96 to 86, we'll call it. And there aren't a lot of buyers coming in. If a bunch of buyers were coming in and saying, wow, Raytheon is at a discount, I can buy in on the weakness, that's going to push the price higher. That's not what's happening here. The market's saying, yeah, that's actually a pretty fair price for Raytheon after that gap. So is that the type of name I would want to buy? No. So I like things that gap and then continue higher. That shows you that buyers are actually willing to pay even more. And that's kind of what causes prices to go up in general. This sort of chart, I think Raytheon looks constructive when we gap above 88 or when we break above the lower end of that base, because what that tells me is finally whoever's sort of in this new bucket of investors, people are willing to pay more and they see something, they see some signs of optimism or reasons for optimism with Raytheon. The chart is telling you that they're just not seeing that yet. Great questions, by the way. And I would say Humana really constructive with the gap and then the follow through. Raytheon certainly not, because we gapped lower and it's sort of just treading water there. AVS, hello, Dave. What is your view on XLE? Seems like it is getting close to a hard trendline resistance. So I'll tell you, with energy, I would say Compared to other sectors, it looks pretty good. But again, that is a questionable way of differentiating yourself here in August of 2023 because the average sector is actually struggling quite a bit. Defensive sectors like utilities and real estate really haven't done particularly well. Growth stocks have certainly been struggling with tech, communication services rotating lower. And so what's starting to work? Well, it's been things like energy. It was things like financials until you had banks, talking about getting downgraded. So a lot of those gapping lower this week. So I think that's no longer as attractive of a setup. Industrials, probably one of the stronger setups. Healthcare with a lot of names that have done particularly well here. But energy is sort of an interesting space because, again, it's been going up when the broader market has not. So I think from a relative strength perspective, if I had to be in equities, and a lot of my time was spent working with institutional investors primarily, you had to be fully invested all the time, or at least the people that I worked with. And so it was not a question of, do I want to own stocks or not? Can I go to cash? You couldn't go to cash. You had to own something. So it was, where are the best opportunities when the markets are struggling? You look for the things that are outperforming. So I think what's encouraging about energy is that the relative strength line is turning up. And if you're wondering what sort of sectors I would be leaning into in a period of market dislocation, which I think we're in, I would be looking at sectors and ETFs where the relative strength line is improving, and I think energy is one of those. Now, you're picking up on a very concerning issue, which is the fact that the XLE is testing a pretty major resistance level. You mentioned a trendline resistance. I think it's more about this sort of level up here, right? If you look at the XLE, we're sort of trading up to the highs, right? The highs, the all-time highs that really were sort of 2022 to 2023. We're all sort of just above current levels. Now, a lot of individual energy stocks are actually breaking out and pushing higher, and that's what gives me a little sign of optimism about the XLE following through to the upside. But you have to remember that the energy sector is really dominated by some of these big integrated stocks like ExxonMobil, like Chevron, and I would say they still have quite a bit to prove. Chevron, by the way, is still below its 200-day moving average. So, I think there could be further upside if these things keep breaking out. I'm more impressed by the higher lows that I'm seeing in energy at a time when most stocks and sectors are making lower lows or certainly lower highs. So again, on a relative basis, if you have to be in stocks, energy might not be a bad place to be. Arch Nikhil, DBA, DBB, DBC, these are all the commodity ETFs. Can you review the charts of commodities? 100%, yeah. So DBA, anytime I bring up the DBA, I think of my conversations with Miss Schneider from Market Gauge. When she comes on the show, she's often talked about agriculture. She's a former ag trader, and so it's always really interesting to talk to someone who used to trade this space, someone who traded something like this in the pits. You have a very visceral, very real connection to these markets because of that time spent, I think. And it's unfortunate a lot of those trading floors are shuttered, if not completely gone, because I think there's a really interesting dynamic there that a lot of newer traders are missing out on. So what's interesting, we'll start with the high level, right, with DBC. And if you look at the commodity space overall, rotating higher but stalling out. And I think that's the issue that I would say, and probably playing with the chart of energy that we just looked at. I think the potential for energy, for materials, for commodities, basic materials is very much there. The concern, though, is that a struggling market kind of can bring everything down, right? I was taught that a rising tide lifts all boats. So get the market call right. And then if the markets are doing well, then the average stock is probably doing well also. If the market call is bearish, then most things are probably going to go down. But I think what I've learned over the last couple of years are some really specific examples. Think energy in the first half of 2022. The S&P, the NASDAQ were getting absolutely crushed, and energy was ripping to the upside, right? Small materials doing exceptionally well. So I think what you have to remember about some of these smaller sectors that are lower weights in the S&P and the NASDAQ actually can do quite well while the benchmarks are struggling. For now, though, I would say with the DBC and with commodities in general, testing resistance and the way that I would think of the chart of the DBC, again, going back to those three phases, is the chart going, is it going up? Is it going down? Is it going sideways? It was certainly going up in the first half of 2022, certainly going down through the middle of this year, but arguably now it's been more consolidating, right? If you look, anytime you can draw a rectangle around the price action, I think that's pretty important. We're now at the upper end of that, which means we get above 2450, we'll call it 25. I think that completes a rotation. I wouldn't be surprised if the NASDAQ continues to retrace and something like the DBC actually breaks out, and things like energy and raw materials actually can do quite well in that environment. But it's not from a purely technical perspective, I would say, probably not quite there yet. Now, DBB is looking at base metals. I think when you look at metals in particularly, very weak. And I think the argument for something like DBB now is it's gone down a ton. And I know investors that like that sort of approach, buying things that are beaten down with the idea that it's down so much, you're betting on mean reversion back to the upside. I could see that argument for DBB, but I would much rather be patient and wait for signs that base metals are actually rotating higher, right? And things that come to mind would be like the MACD or PPO indicators, right? Something that tracks a downtrend and confirms when that downtrend is over. That's what I think when you're looking at DBB, when you're looking at the base metals, I think that's what you need to be concerned about. With agriculture, probably one of the better setups of all of them because it's been a stronger uptrend and it's pulled back a little bit. So out of all of these three, I would say in terms of actionable entry points, agriculture probably would get my vote out of those three if I had to pick. So overall, I think commodities could be an interesting space. I've not seen enough of a follow through, and some of these have stalled out to the point that I think being patient is probably one of the better opportunities. Folks, that is it. The live Q&A in 30 minutes shot by, I feel like, in 2 minutes. I really appreciate all your questions. We're going to do this more often because we're getting great participation and good questions. Tell your friends. We'll be back next Wednesday at 10 a.m. Pacific, 1 p.m. Eastern. Until then, trade safely and join me for the final bar, won't you, at 4 p.m. Eastern today. Take care, guys.